Welcome to Veranda CA. In today's session, we will be discussing about penalties. So, when you say penalties, there will be several sections in penalties which would have been covered in the respective chapters of our class itself. So, what we will be seeing here is probably a gist of all TDS provisions which is there, penalty provisions which is there, and then a few critical provisions. So, few critical provisions will also be discussed here. So, we will start with the summary of understanding what are all the provisions as far as penalty is concerned. So, the first one is section 221. So, 221 is basically for default in making payment of taxes. So, when there is no payment of taxes, the penalty could be levied. Such amount as officer may impose, but not exceeding the amount of tax in arrears. So, it is the maximum, let us say 100% of whatever is arrear, right. So, that could be the maximum penalty that could be levied for section 221. Now, the next one is 270A. 270A we are not going to discuss right now, because we are going to have a separate slide to in detail understand what this 270A is about. Probably you will be reading this word underreport, misreporting, all this. So, let us not get into this right now. We will see this in the subsequent slides. So, the next one is 271A. So, 271A is basically when you are supposed to maintain books of account under section 44AA, but the assessee has not maintained the books of account, you will be levied a penalty of 25,000. When I say automatically, of course, it is only at the discretion of the assessing officer. So, you will be levied a penalty of 25,000 for failure to maintain these books of account who have been required to maintain books of account under section 44AA. And then you have 271AAB where it is relating to a search. So, if it is relating to undisclosed income, it is 30%. If it is relating to specified previous year other than the cases above, it becomes 60%. So, only cases if the minimum penalty will be 30% relating to when he is actually admitting and the proceedings are taken care accordingly. In that case, it is 30%. If there is no, if there is any other case, that is, if there is other than the specified previous year, for any other case, it will be 60%. And then you have 271AAC, where income is determined by the assessing officer, includes section 68, 69, 69A, 69B, C, D. What are these? These are all probably unexplained. So, that is your unexplained credits, unexplained credit, unexplained investment, unexplained expenditure. So, all these unexplained numbers. So, when probably something has been discovered during the assessment or discovered during the search process, you have been identified as someone who have not explained a particular source of income for which a separate tax is taxed under section 115 BBE. A penalty has been levied in such cases. The penalty is up to 10%. Why is the penalty so low, right? Because you say that he has not reported that income, he has not explained the source for that particular income. Then why is it 10%? It is because you have a higher tax rate. So, put together you will actually have paid a tax of 75%, including your surcharge. Surcharge alone is 25%. So, you would have paid a higher taxes while paying taxes itself. So, since you have already paid a higher tax rate, let us say your actual tax rate would have been 31.2%, you have ended up paying 75%. So, in that case you have already paid a 40% there. That is why the penalty here under section 115 BBE is only 10%. So, that is what is there. So, if such income which is categorized under unexplained income is penalty is levied under section 271 AAC. Next one is 271B. If you are supposed to get your books of accounts audited under section 44AB, when are you supposed to get your books of accounts audited? Typically, when your turnover is more than 1 crore and you are not falling under this 44AD category, where you claim this presumptive income, and you are also not falling under the category of this wherever the small and medium enterprises, whereby this your turnover is less than 10 crore and at least 95% of receipts and payments are through banking mode. If that is the case, 44AB is not applicable up to 10 crore. If you are up to 2 crores, you may opt for 44AD depending upon the business. But let us say you are actually eligible under 44AB, but you are eligible under 44AB, but you have actually not completed. Failure to get accounts audit or furnish a report. So here it is 1/2%. What is that? It is 0.5% of total sales, turnover or gross receipts, or 1,50,000, whichever is less. So it is well. So whichever is less. So here whatever it is, 0.5% of such turnover or 1.5 lakhs, whichever is less. So that's what is actually applicable. So probably the maximum penalty for not getting accounts audited under section 44AB is how much? The maximum penalty, how much is it? The maximum will be 1,50,000. Next, 271BA. What is 271BA? It says you must follow provisions of 92E. What is 92E? You will have to file an accountant's report for transfer pricing. Once you see the number 92, it is all about transfer pricing. So 92E is about accountant's report to be furnished in Form 3CEB. So this is relating to TP proceedings. So in TP, if you are supposed to file a Form 3CB, if you have not filed a Form 3CB within the due date specified under the specified, that is section 139, then a penalty of 1 lakh may be levied. All these penalty that we are talking is at the discretion of the assessing officer. It is not something automatic at the time of filing itself or something of that kind. Let's say you have not filed, maybe you may not get a notice immediately also. So all this happens after you providing an opportunity, asking you why you have not filed and all those things, and only then a penalty could have been levied. It is only at the discretion of the assessing officer. So that's very important, something that has to be understood. So this is for TP report. And the next one is about 271C. This is about TDS deductions. Let's say TDS deductions, if there is any failure in TDS deductions, whatever amount that should be deducted, that is 100% of the tax that has to be deducted or paid, that has not been deducted or paid, that will be the penalty. So that is covered under 271C. 271CA is basically TCS. As I have told you, 17 discuss about chapter 17 is for your advanced tax, TDS and TCS provisions. So now TDS is discussed under 17B, that is TDS. BB is TCS. So BB here is TCS. So whatever is 100% of tax not collected. So wherever TCS is applicable, like your scrap sales, a car dealer, or any specific persons who has been covered under TCS provisions, if if it has not been collected or whatever, then equal to tax not collected is levied. And then 271D, 271 is D, where there is in contravention of section 269 SS. What do you mean by 269 SS? Whenever you are accepting any loan or deposit, it has to be in the proper banking mode, that is electronic mode, through NEFT, RTGS, account paycheck or whatever. So if it is not received through the banking mode, then an amount equal to loan or deposit taken or accepted will be levied. So amount equal to loan or deposit, that is 100% of, let's say, loan amount will be considered as the penalty. So that's what is 271D is about. And then you have 271DA, where it is about 269 ST. So 269 ST is whenever there is a receipt of more than 2 lakhs, it has to be definitely in banking mode. So in 269S is for loans alone, taken or granted. 269 ST is for sales. So whenever you have made a sales and you have a receipt, such receipt, if it is in excess of, if it is 2 lakhs or above, it has to be definitely in the banking mode. If not, whatever is such receipt should be, will be levied as penalty. And DB is 269 SU. This is a provision that is applicable from 1st November 2019. What provision is this about? This provision is basically whichever company, entity which has turnover more than 50 crores must definitely collect their entire receipts only in banking mode, So that must be 100% bank. So only then, so 50 crore business. So any person, any assessee who has more than 50 crores of turnover or gross receipts, 100% must be collected through banking modes. It could be through your UPI or card facility or whatever facility it is, but it has to be collected through banking mode. If it is not being followed, if they don't say they'll have to actually specify it in a portal saying that they are adopting it. If that is not there, then 5,000 per day. So that is for 271 DB. 271E is 269 for 269T. 269S is for loan taken or granted, right? 269T is for repayment. So the repayment is by a mode other than banking mode. Then whatever that equal amount, that is 100% of this amount will be treated as a penalty. So that is about 271E. The next section is 271FA. 271FA is about annual information return. There are certain persons who will have to file their annual information returns. Let's say bank, for example, security dealers, for example, they will have to disclose annual information return to state that these are the transactions conducted by so and so persons. So whatever we are seeing in 26 AS, whatever we are seeing in this annual information statement which has been recently introduced, all data from that is through annual information return filed by various authorities. Your bank balances, your interest accounts, everything is being furnished through this annual information return by various financial institutions. So this is annual information return which has to be filed. If not filed, it is 500 per day for default. And you also have, let's say there is a notice saying that, see, you have not filed, please file your annual information return. Even after then you have not been filing, then it is 1,000 per day of default. So that's another thing. So that is 271 FA. Then you have 271 GB where there is a failure in 286, that is your CBCR, that is country by country reporting, which we have already discussed in transfer pricing. So we have also discussed about this fee. So it is 5,000 per day up to 30 days, and beyond that is 15,000 per day beyond 30 days. So similarly, producing of documents under 271 GB 6. So if you are supposed to furnish any document relating to this, if you are not furnishing, then it is 5,000 per day, during which the failure continues. And then you have 271 GB 2. So even after serving order, if you are not filing this CBCR, 50,000 per every day for such failure beginning from the date of such order. If there is any inaccuracy in that CBCR, then it is 5 lakhs. So the penalty goes up to 5 lakhs. And 271 GB 4 also says, if you have been requested to understand about this inaccurate information on this again CBCR only, again it is 5 lakhs. So basically, if there is a failure to inform any accurate, that is, when you say failure to inform, you know that it is inaccurate but you have not informed. In case if they themselves have found out this is inaccurate, in any case it will be 5 lakhs. So that's about 271 GB 4. And then you have 271H, which is for TDS and TCS, where your regular demand and other things. So penalty shall not be less than 10 cents but not extend 1 lakh. So for that, if there is any incorrect information relating to this 200 and 206, which is relating to TDS and regular tax collections, so in that case 10,000 to 1 lakh would be the fine. So this is also another thing relating to TDS thing. Incorrect information by an accountant. This is something which was introduced like 3 years before or something. So this is a fine, this is a penalty for the accountants, for us. So for us chartered accountants, they say that if you are actually filing incorrect information in a certificate, you will be asked to pay a penalty of 10,000 for each certificate. So whenever you are filing an incorrect statement, if it is found out that is incorrect, an auditor has to pay 10,000 penalty, provided it is found out and it is requested by the assessing officer. So it is very critical, because chartered accountants importance is what drives the economy. So if something is found incorrect or whatever, they may be levied penalty about. And failure to comply with section 133B not exceeding 1,000. So that will be the fine. So that is basically when you are not following with the directions of the assessing officer, you may be levied a penalty of 1,000. And if you are not complying with the provisions of 139A and other things, this is typically about PAN. There are various places where you need to quote your PAN mandatorily. There are various situations where you need to obtain a PAN for sure, and there are time limits before which you will have to obtain your PAN. If you are not obtaining your PAN, or if you are not disclosing any transactions to that particular person to whom you are supposed to report your PAN, if that is found out, you will be levied 10,000 for every default, for every default. So whenever you are supposed to report your PAN, you are not reporting, you will be levied 10,000. Failure to comply with section 203A, rupees 10,000 for each failure default. So for this failure also it is 10,000 for each failure or the each default. So that is also covered here. And then you have 272 BB. If you are actually quoting false, so if you are quoting false TDS or false TAN or PAN or whatever it is, so whatever relating to TDS information you are giving, so this is also like the previous section, that is 203A only, which is relating to TDS only. So if you are quoting false TAN or false information relating to TCS, it may be anything related to challan, certificate, statement or document. So for any false information, 10,000 will be the penalty. 272A, it's a kind of critical section. That is, when you say critical section, whenever an assessing officer raises a question to a particular person of the assessee or the concerned assessee, so such person should have to answer the questions, should have to sign the relevant statements, should have to comply with whatever powers have been given to the assessing officer under section 131. If a summon is issued, he has to appear. If he is asked to produce certain information, the assessee has to produce. So if there is no cooperation, no cooperation by the assessee, in that case what happens is there will be a penalty of 10,000 for each failure or default. So when you say no cooperation, it includes these notices also, that is your 142.1, which is for requesting information, 143.2, which is for scrutiny assessment. And then you have another set of penalties in 272A itself. It is basically when you are requested to furnish information under 94, you are not furnishing. What is 94? Things like dividend stripping, bonus stripping, all these things where your intention is to avoid tax. These are also something like SAR. So if there is a failure from your part in providing the required information to against section 94, then penalty could be levied. Similarly, if you have discontinued your business, you are supposed to report to the income tax department within 30 days. So once you discontinue your business, you will have to do it within 30 days. So if you are not furnishing within 30 days, you may be levied a penalty. And similarly, whatever return you are supposed to file, that is, be it your trust return or your TDS returns or your TCS returns, whatever returns we are talking about. So let's say your IT return, your TDS return, your TCS return. So all this has to be filed on time. So if not filed on time, then again, if you have required to deduct taxes and you have not done, so all those things is covered. And similarly, the TDS submissions, another thing. So it is all about TDS and TCS. Whenever there is a requirement about TDS, TCS, which has to be done on time and filing return on time, reporting under section 94, reporting for discontinuance. If something of this is not done, then again a penalty could be levied under section 272A. How much will it be? It will be rupees 100 for every day which the failure continues. So that's what the penalty is about. So for all of this, the penalty shall not exceed the amount of tax deductible or collectible. So wherever the penalty is related to TDS, TCS, the maximum is 100% of such TDS, TCS. It cannot go beyond 100%. So it can never be, penalty can never be above the tax levied. And this section, that is the last one which we are seeing here in this particular slide, the 273B. 273B is very critical. The reason why it is critical is, when I say critical, actually it follows the guideline which income tax stresses in every section related to assessment. We said opportunity must be provided. An opportunity must be provided to the assessee. Only then the department, the assessing officer can take an action. Whenever there is a increase in taxes or reduction in losses, the assessee must be given opportunity to see that, to explain his side, so that the assessing officer will be able to take a stand on such decisions. So again, here also it says no penalty. So see the word, no penalty shall be imposable as the case may be, said provisions if he proves that there was a reasonable cause. So, on providing the opportunity, if the assessee says he has actually sufficient cause to say that he has not complied with such things, reason for not filing return, reason for not filing 44AB, all these things, if it could be proved, that the reason for the failure is a reasonable cause, if it is a genuine cause, why it has not been filed. So, there are even cases where the assessee was supposed to file, let us say, a 44AB. The employee of assessee was working on that 44AB file with the auditor. It was finally signed and everything. Initially, it was all manual filing. So, you will have to go and file it in the Tapal within the due date. It is not like your e-filing. So, let us say that particular officer forgot and kept it the 44AB in the drawer. The next day, he met with an accident or something. So, he was not coming to office. The assessee, that is the company, thought it has been filed. The company thought it has been filed, so they did not bother about. 1 year later or something only, they realized it has actually not been filed. Then they realized it's actually in the drawer only. They went on to say, see, the concerned employee met with an accident, so we thought it is actually filed. Only now we have realized that it is actually in the drawer itself, so excuse us. So, this is also held to be a reasonable cause. So, when you say reasonable cause, it could be anything. If it could prove that it was not, there was a genuine reason why there was a delay. So, if the delay is genuine, right? The delay is genuine and it could be proved to the concerned assessing officer, no penalty shall be levied. So, penalty will not be levied in such cases. That is what we call. So, we use the term reasonable cause for failure should be explained to the assessing officer. So, that is what we are referring to here in this 273B. Okay. Moving on, we will see few sections before completing this penalty chapter. So, as far as penalty is concerned, one of the important chapters as far as your exams is also concerned is this 270A. This 270A is basically to understand who can levy this penalty. So, it can be an assessing officer, it can be Commissioner of Income Tax Appeal, Commissioner of Income Tax or Principal Commissioner of Income Tax. So, it could be one of these 4 people. When will this income reporting of income, that is, when will this penalty be levied? Whenever there is under-reporting of income. There is also something called misreporting. We will see that a little later. So, for now we will just understand under-reporting of income. So, what do they mean by under-reporting of income? How do they actually do? So, they take return of income, they see that return of income has been filed. In such cases, whatever has been assessed will be considered and said that you have under-reported income. Let us say you have actually filed an income of 50 lakhs, return of income has been filed, but what has been actually assessed is, let us say, 70 lakhs. So, 20 lakhs is your under-reporting of income. Similarly, when no return of income has been filed under section 148. 148 is reopening of assessment where return has not been filed. You conclude and say your income is actually 30 lakhs. So, this 30 lakhs was not reported in the return. So, that is under-reporting. Similarly, reassessment under section 148. So, it was already concluded assessment. Now, we are opening up and saying this is only the final taxable value for particular assessee. The difference will be is what penalty will be levied on. And similarly, when you have, it is again assessed or reassessed, but this time if it is on MAT also, penalty could be levied. Similarly, in case of 2, that is when no return of income has been filed, the assessing officer himself is closing the case. Here also, if he is actually assessing based on the MAT. So, in short terms, what we can say is any assessment, any reassessment, any conclusion where return has not been filed will get covered under this particular. So, on this penalty could be levied. So, how can a penalty be levied on these cases? If under-reporting income is recognized, under-reporting of income is understood during the assessment process, then it could be levied. Even if there is any losses are reduced or some adjustment has been made to income, penalty could be levied. So, basically, let us say you have actually reported 50 lakhs as we said. Now, it is being concluded 70 lakhs. Your income is going up by 20 lakhs. This is under reporting. Similarly, if the loss of 50 lakhs, now your loss is reduced to 30 lakhs. Here also it is under reporting. So, that is what we are saying, reducing the loss. So, these are all the situations where penalty can be levied. So now how do you compute this penalty, and what do you call as underreporting income? Where income is assessed, you take income assessed minus income under section 143(1)(a), that is your intimation under section 143(1), that income versus income assessed. When income assessed is greater than income under section intimation. So if income under intimation is 50 lakhs, this is 70 lakhs, there is penalty, there is underreporting. Income assessed versus basic exemption limit, where return has not been filed. What did we say as 2? Where return has not been filed. Whatever we are saying here is in line with this. So this is what 1, 2, 3, 4, 5, 6, 7. For this is only we are quoting it out what will be the situation. So for 1, it is income assessed versus income thing. And second thing is income assessed versus basic exemption limit, where return has not been filed. And in case of reassessment, the previous assessment income, the current assessment income, this difference. So if the current reassessment is higher than the earlier assessment, then again is there. So if it is based on MAT, so if everything, whatever we are discussing is based on MAT, we will have to take that relevant income of MAT and the corresponding earlier income. So these are the what do you call comparisons between your income assessed here and whatever income has been considered in the previous scenario. So while filing return of income, I have filed it for, let's say, 49 lakhs. During intimation, they have considered as 50 lakhs. Now this 50 is being considered as 70 lakhs during assessment. Then this 20 is what you are calling as underreporting of income. So same case for everything. So typically whatever is the current assessment value minus the earlier assessment value. If it is a positive number, then that is only called as underreporting of income. When you say underreporting of income, we will have to remember this section 273B, section 273B. So what did we say? What did we say in 273B? We said if reasonable cause is provided by the concerned assessee, then penalty will not be levied. Similarly, yes, it is underreporting, but explanation is provided. So when explanation is provided by the assessee, in that case also, and similarly when estimation is provided. See, this is how I actually estimated by income. So whatever I did was only estimation. I have proper explanation why I considered that income. I have a proper explanation on how I have submitted. Whatever I submitted was only an estimation. I did not have the right numbers. So whatever you are doing is only revised estimation. So estimation cannot result in penalty addition. So similarly, when everything has been disclosed, I have disclosed everything. I have not said I have not disclosed. Let's say I have disclosed 50 lakhs in business income, 20 lakhs in exempt income. Now, assessing officer says this 20 lakhs is also taxable and he makes this 70. So this 20 is actually disclosed. I am not hiding it from the assessing officer. I have actually disclosed it in the in the return. I have only treated it as an exempt. So when treatment varies, my disclosure does not change. So my disclosure still is fine. So if you have actually properly disclosed, if your income was only based on estimation, yes, there could be a revised number. And if you have properly given explanation, then underreporting 270A penalty cannot be levied for underreporting of income. The last category of where underreporting of income is not possible is in transfer pricing cases. Transfer pricing because of arm's length price is purely a statistical adjustment. So I say my arm's length price is 1.5 lakhs, correct? And assessing officer says my arm's length price is 2 lakhs. This difference is notional, is all statistical, is not the exact number that we are talking about. It's an assumption. Based on certain assumptions, you have come out and said you should have actually transacted at 2 lakhs. You only transacted at 1.5 lakhs. So this 50,000 is an income to you. This cannot be called as a penalty situation. So underreporting of income cannot be considered for transfer pricing adjustments. The next category, we said we'll understand this a little later, that is your misreporting of income. So what do you mean by misreporting of income? It includes misrepresentation or suppression of facts. So there are certain facts which are misrepresented in the books or in the written or before the assessing officer. So it could be misrepresented in the books, in the written, that is your return of income, ROI, and before assessing officer during the assessment. So the misrepresentation or suppression could have happened in any of these stages. Similarly, failure to record investment, so that is also one of the reasons which will be called as misreporting. Claim of expenditure not substantiated. You have said you have paid 5 lakhs as professional fee, but you are not able to substantiate why you wanted to spend this 5 lakhs. If it's not possible, again it could be called as misrepresentation. Recording of any false entry. So in books, if you have actually recorded any false entry, it will be treated. Failure to record any receipt, similar to this. So there we said expenditure is recorded but claim is not supported. Here we said you have actually got a receipt but you have not recorded. Here you have recorded an extra expenditure. Here you have not recorded an income. So that's the opposite, because it's income and expenditure. Income, if not reported, is favorable to the assessee. Expenditure, if reported in excess, is favorable to the assessee. So that's the point, and that's the connection between these two causes. And finally, failure to report TP transaction. In the previous slide, in underreporting, we said a transfer pricing adjustment for arm's length price will not be considered as underreporting. But when there is a failure to report TP transaction, then it is misreporting. So I said I have sold 10 lakhs to my holding company. If I am not reporting it in my books of accounts or whatever, then it is failure to report TP transaction. When I say books of account, it is basically while submitting the form 3CEB. So when I am submitting 3CEB, I have not declared this 10 lakhs, which is wrong, right? Which is misreporting. So that's what they are calling it as failure to report TP transactions. So now what is the penalty for this? If it is underreporting, it is 50%. 50% of such income will be treated as, such tax will be treated as penalty. For misreporting of income, 200% of such tax will be calculated as your penalty. So that's what is all about. If you do not want to have all these penalty issues or something, if you feel that assessing officer should not raise penalties on you, you can go on an imposition. You can go on an imposition of penalty under section 270A. What exactly is that? It is basically immunity. What is immunity? You get freed, that is, you will not get affected by such consequences. So that's what you mean by immunity. So under section 270A, if there is any penalty that might happen under 270A, you can claim for penalty. Similarly, proceedings under 276C and CC, things like your recovery proceedings and all those things. This could be as to hold on that when you have filed for an immunity on this imposition of penalty. So you are requesting for a grant of leave, that is, please do not disturb me. I will oblige to whatever you are asking for. I will pay the taxes. I will not go on an appeal. I will follow everything that what you say, but don't levy penalty on me. Don't go with other severe procedures with respect to me. So this is what is called as an immunity. So what for we are actually demanding immunity? The tax and interest payable. So the tax and interest payable as per the order of assessment have been paid. So the first condition for immunity is 100% tax should have been paid and no appeal for such order has been filed. So you will have to give away the right of filing an appeal. Only if these two conditions are followed, you can file actually an immunity. So when should you file? It should be filed within 1 month. It should be filed within 1 month from the end of the month in which order was received. So if your order is received on 10th February 2022, your end date is 28th February 2022 and 1 month is 31st March 2022. So it's not days, it is not 30 days or something, it is a month. So it is 31st March 2022 will become the due date for filing such application for immunity. And he may grant immunity after the expiry of the period of filing. So when you say for filing CIT appeal, the due date, the timeline available is 30 days. So after the 30th day, this can be granted. Immunity may be granted or rejected. So that's what they are trying to mean. So an order will be passed before when? Before 1 month, period of 1 month from end of the month in which application received. So in our case, we received an application on what date? 20th February 2022, right? So 1 month from this end. So the order also should be passed between 31st March 2022, in which application is received. I've just restated dates. So basically, when an application was filed on 20th February 2022, the end date is 20th February and 31st March. If you actually wanted to continue the similar example which happened earlier, actually it was filed on, application was received from the end. So it should be filed before 31st March. So from that month end, you will have to take 1 month. So hope you are clear on how to compute this 1 month. So for application, it is from the order time. For passing an order, it is from the application time. So that's what we are calling here. And then you have, as we said, very common between income tax, you need not even discuss about it. Moment you see that something is not favorable to the assessee, as we said, additional taxes, reduction in losses, if there is something of this kind, unless an opportunity is provided to the assessee, it cannot work. So that's what this is also saying. And this is the final. He cannot go on an appeal on any of this. So no appeal under section 246A or revision under section 264 can be. So once immunity is rejected, there is no going forward. So that's what the provision says. Now there are situations where penalty is levied and you are trying to plead and say, please reduce the penalty for me. So there are certain cases. So the 273A discusses about such cases. So it says it is purely at the discretion of principal commissioner or commissioner whether to waive the penalty under section 270A. What are the conditions? Full and true disclosure should have been made by the assessee, cooperation in inquiry, payment of tax or interest. So whatever is due should have been paid. The assessee should have cooperated. Full and true disclosure should have been given. If that is done, then with the prior approval, the principal chief commissioner, principal director general or director general required if the aggregate amount exceed 5 lakhs. So only if the aggregate amount is exceeding 5 lakhs, they require this prior approval. Relief available only once in a lifetime. So the entire lifetime, we can only claim this relief only once. That is the particular assessee who wants to claim this waiver of penalty or reduction in penalty, he can only raise once in the period of his lifetime. On all other cases, this is basically at the discretion of principal commissioner, right? So he feels something has to be done for such penalty. So this is purely at the discretion of principal commissioner. But there could be scenario where assessee wants. So an application made by the assessee to principal chief commissioner, what could the commissioner do? He could either create a stay or you can compound. You could additionally say, see, you have 4 penalties, I will combine all 4 and give you one and give you a discount. So this is what is called. So but assessee has to prove that he has genuine hardship, he doesn't have money or he doesn't have the proper fund flow to pay all the taxes which has been raised by the income tax. If that could be done, then if penalty could cause genuine hardship, that is, if they are not actually able to pay, it is completely fine. They may give you that could cause genuine hardship. The assessee has cooperated, and if that is the case, they could waive off the penalty whatever is in. For in this cases, again here also approval is required, but the limit is 1 lakh only. In the previous case, where it is discretion of the principal commissioner or commissioner, it is 5 lakhs. But here it is from the assessee only, he only is requesting for waiver of penalty. In this case, the time limit, in this case, the amount is actually 1 lakh. So that's what is there. And whatever order is passed under 273 is final and can never be challenged before any subsequent authority. And the last section that we will be seeing is 273A, where we are going to discuss about power to grant immunity. So typically an eligible applicant may make an application under this section. Generally penalty has already been initiated, so he wants to grant immunity. So similar to what we saw earlier. So before imposition of penalty, this must be levied. So this, once penalty has been initiated, but before imposition of penalty, this could be levied. Cooperated with the person, he must have cooperated and he must have made full disclosure in his income. If there is a satisfied, then it is there. So within a period of 12 months from the end of the month in which application was made, they may either accept or reject the particular immunity under section 273AA. And in all these cases, whenever an order is passed, if there is any failure to comply with any of the condition or concealed any particulars or given false evidence. Basically, if there is something wrong happened with the form, which is intentional wrong happened in the submission of the forms, in that case it shall be withdrawn. That is, whatever immunity was given will be withdrawn and will be something like which it was not given at all. So, that is the impact of grant of immunity. So, with this we have covered all the penalty sections of sections on which penalties are leviable. So, we have also discussed certain sections which are very particularly important for your exam, such as 270A. So, hope you have understood this penalty section. Thank you very much. So,